Is Cisco a buy now? We're going to find out on today's episode. It currently offers a nice yield of 3.1%. We're going to look at the historical performance of the stock over the last 5 to 10 years. We're going to jump into the income statement, look at their revenue growth year on year and see how well the bottom line, that net income, has grown. We're going to jump into their balance sheet and look at their total debt versus their cash position. We're going to take a look at their dividend safety. Can they continue to increase their dividends whilst paying off their interest? And as always, we're going to run it through our stock valuation model, getting to our intrinsic value with our margin of safety to get to our acceptable buy price. Now, Cisco is up 5% year to date. It is towards that 52-week high and does offer a very nice yield of 3.1%. For those shareholders who have been holding the company for the last 10 years, you would be up around 95% without dividends reinvested. Not the worst, but also not the best for a 10-year period. So, are we going to see nice growth from this point on? Let's find out. Now, their revenues over the last 5 years, we can see July 2018, they reported revenues of 49.3 billion. And in 5 years later, July 2022, 51.5 billion. Now, typically, I like to see 3 to 7% growth year on year. And what we can see here, it has been essentially very, very slow, if not flat, throughout the last 5 years. We can see some years where it did, in fact, decrease. So we're going to take a look at that shortly in our financial metrics. Bottom line, their net income, July 2018, they reported net income of 110 million, which looks like to have been a one-off because for the next 4 years, they were up there in the 10 to 11 billion worth of net income. Now, again, over the last 4 years, what we can see is that it has essentially remained relatively flat over the period. Again, something we should take a look at when we look at our financial metrics. Now, dividend safety score 91. It is very safe. Market cap 205 billion, making a mega cap. And in terms of some key financial metrics, they have been paying dividends for 11 years without a reduction. In terms of the recession facts and figures, there was no dividend paid in the last recession. They did have a negative 14% worth of sales. However, this was the average growth during the period. And unfortunately, the recession return was negative 59%, which was worse than the S&P 500's negative 55%. So something to think about for potential investors who believe we are heading into a recession. Now, the last 18 years, the dividend has compounded 18% year on year, which is great to see. 6% over the last 5 years. And their latest increase was below that 4% that I like to see, given the US inflation rate was 4% over the last 40 years. So you are losing your purchasing power if you are receiving dividends, salary increases, or even other income-producing assets below 4%. So that's negative in my opinion. But it is positive to see over the last 5 years and 10 years these very strong numbers. Now, dividend yield theory states that a company is undervalued when the current yield, as we see here, is sitting above the 5-year average. So what we can see here is, based on this, it is looking reasonably valued. However, we can see the forward PE is trading slightly below that 5-year average. So there is that sign of undervaluation. The sector PE is significantly higher at 24 as opposed to Cisco's 12.5. And as I mentioned before, it is trading towards the upper end of that 52-week high. However, it does not mean it's overvalued if it's right at the top, nor undervalued right at the bottom. Earnings payout, purely only looking at the free cash flow payout, as it's one of my 7 golden dividend metrics. Do check out the pinned YouTube video. With the earnings, it is susceptible to manipulation through management by accounting, but they do show a very similar story. I do like to see below 60% for room to grow that double-digit dividend that I like to see. And positive to see 49% in 2022 and expected to be 36% in 2023, which makes sense why we have a very high dividend safety. Likewise, I do prefer to look at the free cash flow per share, and what we can see, they do mirror a very similar story. Nice steady growth year on year, $2.20 in 2013, $3.06 in 2022, with 2023 expected to be $4.29. Now, yes, I do like to see an upward trending graph, and that's why I like to look at a minimum of 10 years worth of data. But what we can see, there have been some years where the growth has been very, very limited, and then some years from 18 to 19 where it was very strong. Likewise, expected to be 2022 to 2023 with that increase. So a lot to consider moving forwards. One thing that I don't really necessarily like about Cisco, as we can see here, their growth in their sales year on year, it doesn't really hit that 3 to 7% that I like to see. In fact, what we can see is there have been years of negative growth and some years of essential flat growth. Better seen below, 48.6 billion worth of sales in 2013, 51.6 in 2022. So it looks like they are struggling to increase their sales. And the fact that they have struggled over the last 10 years does make me worry how they will look to increase this over the next 10 years. So something to bear in mind. Shares outstanding, company when they do buybacks, returning excess cash to our shareholders, 5.38 in 2013 and 4.19 billion in 2022. So it has dropped. There have been some years where they have done some very nice buybacks, 2018 to 2019. So this is fairly positive to see, along with that fairly nice starting dividend yield. ROIC, another one of my 7 golden dividend metrics, plus 10% for management to effectively allocate their capital. What we can see over the last 4 years, it has been around 25 to 28%, which is very positive. So it does give me faith in management. So that's positive with regards to ROIC. Another thing that I could tell by looking at the income statement was the fact that their operating margins were very, very strong, 12% plus, which is very nice to see. Free cash flow yield, again, very, very strong. Now, before we jump into the net earnings and this net EBITDA, this is essentially saying that the company's debt levels are very, very low, that they can't easily be covered by their cash. And this on the right, again, it's nil, showing that the company doesn't finance anything from debt or with equity. Now, before we jump into the stock valuation model, let's have a very quick look at the balance sheet just to see how that total cash compares to their total debt. Now, what we want to see here is the movement over the last 5 years, and what we can see, the total cash and short-term investments, 46.5 billion in 2018, and in their latest quarterly report, it has essentially halved to around 23.3 billion. Now, what's interesting to see is how that correlates to the total debt. And what we can see here, their total debt has gone from 25.6 billion to just below 10 billion. So they have been paying off a lot of that total debt. And we can see that all of that will be essentially covered if they ever need to purely by their cash and short-term investments. So a very, very good positive thing for Cisco in terms of their debt level. So there is no worry there whatsoever. Now jumping onto the stock valuation model, as always, if value is being provided, hit the like button, hit the subscribe button for continued content. And as always, if you want to grab a copy of the stock valuation model, check the pinned comment where you can run your own company through this model, finding out what exactly your intrinsic value would be for your own companies. Now the stock is Cisco with the earnings per share 2.79, growth rate as expected by analysts at 10. We have the yield on AAA corporate bonds at 4.59. Giving an intrinsic value of 45.47, slightly lower than the current trading price, showing around 10% overvaluation. Now we have companies in a similar sector and index size. We have Hewlett Packard, Juniper Networks, Motorola Solutions, and Dell Technologies. While using the stock price and earnings per share, we get the P multiple, which we get the average, multiplied by the earnings per share to give a price of $68 for Cisco. We can see here very nice upside based on the multiples valuation model. Dividend discount model, we have the yearly dividends year on year, and we can see the average growth rate around 3.41%. Given the very consistent nature of the business, I've gone for essentially the same forward looking, and this gives a DDM price of $35, showing significant overvaluation to that current trading price. Now the discounted cash flow model, we put the free cash flows in. We have the average growth rate at 1.2% with a forward looking at 3% as per analyst estimates. Using that discount rate, we then get the present value of these future free cash flows and terminal value. Once we add that together with the cash, subtract the total debt, we get to our equity value, which divided by the shares outstanding, again shows a price of $65. As always, if you are enjoying the content, do hit that like button, do subscribe for continued content on your doorstep. Now, the intrinsic value is essentially the average of the 4 models we've gone through. So the intrinsic value is showing $53, which, as we can see, is showing very minimal upside to that current trading price. Typically, for a wide company with a wide moat and nice historical data that we've just run through, very strong financial metrics and forward-looking data, I would argue a 10% margin of safety is sufficient. However, for Cisco, I would look for a lot more personally. Those looking for 10% would be looking to buy around $48. Again, well within that 52-week range. And again, that is something that has happened recently. Personally, I would be looking for around 25%, but if you were looking for 20%, your acceptable buy would be $42. And me personally, I would be looking for around $40 before entering, and this is right there towards that 52-week low. Now, Wall Street do forecast the price over the next 12 months to hit around $55.91, showing around 10% upside to that current share price. As always, let me know your thoughts in the comments. Are you a shareholder? Are you looking to buy or looking to sell, or are you even on the sidelines? And as always, have a great day. Like, subscribe, and catch you on the next episode. Take care.